Good morning, students. It's time for business studies. We are still on the topic determining the net worth of a business. Remember, our last subtopic was the bookkeeping equation. Our next subtopic is the balance sheet equation. That's lesson number 3. Our lesson objectives are: by the end of the lesson, the learner should be able to 1. Prepare a balance sheet as per its format. 2. Calculate capital from the total assets and total liabilities. What is a balance sheet? A balance sheet is a financial statement that shows the financial position of a business at a given date and at a given time. You can say at a particular date and particular time. You can also say at a specific date and a specific time. It's usually prepared at the end of a trading period or an accounting period, depending on the organization. The period can be 1 month, 3 months, 6 months, or 1 year as the accounting period. In most organizations, it is usually 1 year. Let us look at the format of the balance sheet. Normally, 1, it is T-shaped in nature. It has a heading. It has the left-hand side and the right-hand side. The assets are normally on one side of the balance sheet. Capital and liabilities are on the other side. The total of the two sides must be balanced as per the balance sheet equation. We shall have an example to illustrate the format of the balance sheet, and then at the same time we determine capital from the prepared balance sheet. In example 2, we have land 100,000, premises 60,000, cash in hand 40,000, cash at bank 20,000, stock 25,000, debtors 10,000, furniture 9,000, bicycle 7,000, long-term loan 20,000, creditors 12,000, loan from bank 13,000, repayments 3,000, and accrued expenses 2,000. Yahiya's traders had the assets and liabilities for the accounting period that ended on 30th June 2016. Determine his capital and the prepared balance sheet as of 30th June 2016. We shall make a balance sheet as below. It must be T-shaped in nature. You see it is T-shaped. It must have a heading. The heading is Yahiya's Traders Balance Sheet as of 13th June 2016. The assets and the assets which are fixed assets and the current assets are on the left-hand side, and then the capital and the liabilities are on the right-hand side. We shall start with the assets, and in this case we have land, which is 100,000, fixed asset, premises 60,000, furniture 9,000, bicycle 7,000. If you add the total fixed assets, you get it's 176,000. We go to current assets. We have stock 25,000, debtors 10,000, cash at bank 20,000, cash in hand 40,000, prepayments 3,000. You add the current assets, you get that is 98,000. So total current assets and fixed assets, you get 274,000. You might want to know what prepayments are. Prepayments are expenses settled in advance before you incur them. Now, when we come to the right hand side, we have the long-term liabilities. We have long-term loan, which is 20,000. Then we go to short-term liabilities. We have loan from bank, that's 13,000. We have creditors, 12,000. We have accrued expenses, 2,000. If you add the total, becomes 27. Now you might want to know what accrued expenses are. Accrued expenses, they are expenses that have been incurred and they are yet to be paid. So they are short-term liabilities because they're supposed to be paid within a shorter period. Normally it is a period of within a period of 1 year. Now from the case of the balance sheet, or the total assets, that is fixed assets and current assets, on the left hand side is 274,000, and the total liabilities, that is long-term liabilities and short-term liabilities, it's 47,000. So we are required to calculate capital, and from the balance sheet equation we have capital is equal to assets minus liabilities. That's total assets minus total liabilities. So in our case, capital is equals to total assets, which is 274,000, less total liabilities, which is 47,000. So we get the difference is 287,000. That is, capital is equal to the excess of assets over liabilities. Note that in our case, the assets are more than liabilities, leading to capital which is positive. When capital is positive, then we say the business is solvent. When it's the otherwise, that is, the liabilities are more than the assets, then we have what we call a deficiency or negative capital. When capital is negative, then we say the business is insolvent. That's the end of our lesson today. Our next subtopic is order of permanency and order of liquidity. Thank you.